Welcome to this analysis of the collapse of Silicon Valley Bank, one of the largest bank failures in the history of the United States. On March 10, 2023, Silicon Valley Bank closed its doors after a bank run, causing widespread panic in the tech industry and beyond. In this video, we'll take a closer look at what led to the downfall of this once successful financial institution. Silicon Valley Bank, SVB, closed after a bank run, causing the largest bank failure since the 2008 financial crisis and the second largest in U.S. history. Reuters reported that, as of the end of 2022, some 89% of its $175 billion in deposit liabilities were not covered by federal deposit insurance. How did Silicon Valley Bank become the bank it is today? Silicon Valley Bank was a commercial bank founded in 1983 and headquartered in Santa Clara, California. Until its collapse, Silicon Valley Bank was the 16th largest bank in the United States. Companies such as Airbnb, Cisco, Fitbit, Pinterest, and Block Incorporated have been clients of the bank. One of the biggest reasons for its current dilemma stemmed from the rising interest rates. As Silicon Valley startups began experiencing success in the late 2010s, Silicon Valley Bank began taking out bonds, and kept a small amount of the deposits on hand. In response to a surge in inflation, the Federal Reserve began increasing interest rates in recent years, causing startup funding to decrease. Startups began to withdraw funds held in the bank, leading to the bank being short on capital. To make up for it, the bank sold the bonds at a $1.8 billion loss. In the week before the collapse, Moody's Investors Service informed Silicon Valley Bank that the bank was facing a potential downgrade of its credit rating. On March 8, 2023, Silicon Valley Bank announced it had sold $21 billion worth of its investments, borrowed $15 billion, and held an emergency sale of its stock. Despite the steps taken by the bank, Moody's downgraded Silicon Valley Bank on March 8. In addition, investors at some venture capital firms, including Peter Thiel's Founders Fund, urged startups to withdraw their deposits from the bank. Customers withdrew $42 billion, leaving the bank about $958 million in negative cash balance. In response, the value of the company's shares fell. By March 10, Silicon Valley Bank stock fell nearly 70% before trading was halted. On the morning of March 10, agents from the Federal Reserve and the Federal Deposit Insurance Corporation, FDIC, arrived at the offices of Silicon Valley Bank to assess the company's finances. Several hours later, the California Department of Financial Protection and Innovation, DFPI, issued an order taking possession of Silicon Valley Bank and appointed the FDIC as receiver. The FDIC responded by establishing a deposit insurance national bank to operate in the failed institution's stead and facilitate access to insured deposits as of the following Monday. According to Reuters, some 89% of the deposits in receivership were uninsured, and the FDIC seeks to find a purchaser for the failed institution to make the uninsured depositors whole. The president and CEO of the bank, Greg Becker, was removed from the board of directors at the Federal Reserve Bank of San Francisco later that day. The collapse of Silicon Valley Bank has caused a ripple effect across the tech sector. In a Securities and Exchange Commission (SEC) filing, streaming media company Roku Incorporated revealed that around a quarter of the company's cash reserves, $487 million, were held by Silicon Valley Bank. Other companies affected by the collapse include video game developer Roblox Corporation and video hosting service Vimeo. Many startups were unable to retrieve money, resulting in companies taking out loans to make payroll. Circle, the issuer of USD Coin, USDC, attested that Silicon Valley Bank is one of the 6 banking partners used by the company to manage its cash reserves for USDC. In the wake of the collapse, concerns have been raised about the stability of other banks, including First Republic Bank and Western Alliance Bank Corporation. Shares of both companies fell in the wake of the announcement of SVB's dissolution. In addition, stock values of U.S. banks have lost a combined $100 billion in 2 days, and European bank stocks lost $50 billion. Despite this, some banking experts believe the other banks are able to remain stable. SVB banked a risky sector of the economy, and financial regulations have strengthened since the 2008 recession. In conclusion, the downfall of Silicon Valley Bank serves as a stark reminder of the importance of financial stability and risk management in the banking industry. While the collapse has had significant consequences for the tech sector and caused ripple effects across the economy, it is also an opportunity to learn from the mistakes that led to this catastrophic event.